Welcome to another episode of The Brand Called You, a podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a very senior professional from the world of finance from New York, USA, Mr. Eric Fiegoli. Eric, welcome to the show.
Hi, thanks for having me. I'm excited to be here.
Thank you. Eric is the managing director of the Exbo Group. Eric, my first question, what inspired you to co-found the Exbo Group and what was the vision behind it?
Yeah, that's a great question. And I wish I could come to you and say I had this dream and this vision to build this company and grow it, but I think in reality
Mm.
these things are a little bit more organic and maybe less planned than we like to think. So Expo Group really grew out of some consulting engagements that me and my business partner Kevin were working on. So this is post business school. I went to business school back in 2014. And post business school, I was working at Amazon and sort of doing a product management role. So something a little bit different out of my background in finance.
Mm.
But I think I always thought I wanted to go back to finance in some way, shape, or form. And my business partner Kevin came to me and said, "Hey, working at a VC. Some of their portfolio companies need finance help. Can you help me with it? This would be consulting work. We can do it on the side." And really, from doing that initial consulting work over the first year or so, we started getting a sense that there was a need in the market consistently for this type of work.
Mm.
And there was an opportunity to provide these services in an ongoing way, and there was a lot of need and demand for it. So Expo Group kind of grew out of those initial engagements, and then it was kind of starting to realize, okay, I think there's an opportunity here.
Mm.
We both left our day jobs and started Expo Group, but I it wasn't as sort of, hey, let's start this company from scratch. It was something that happened
I
and
understand.
evolved over the course of a year or so.
Fascinating journey. Thank you. So let's talk about the Expo Group then, Eric. What are some common mistakes founders generally make in financial planning and fundraising?
That's a great question. So at Expo Group, so I'll just give an overview. So at Expo Group, we're a financial consulting firm, an advisory firm. We advise companies and investors in the growth stage and lower middle market. So these are businesses that are typically from a few $1 million in revenue all the way to $150 million in revenue.
Right.
So ranging in size. Headcount could be anywhere from 20 people to all the way to a few hundred,
Mm.
but still on the smaller range of businesses.
Yeah.
And for us, the biggest thing that we try to instill with some of the founders and executives that we work with is financial hygiene and prudence, and build structure and rigor around the finance and accounting functions at these businesses. Sometimes when we start an engagement, oftentimes it's from a capital event. That's the trigger that brought us in. So typically it's a fundraising round or a change in control and ownership or some sort of recapitalization. So at that point, we're usually being brought in to help either stabilize or build or grow the finance function. So your
Mm.
question was, what kind of mistakes the founders make? I think some of the biggest things that mistakes the founders make is really just not investing
Mm.
enough resourcing in their finance function.
Mm.
And what that does is it kind of makes them, fly blind. So by not investing this capital or by, pushing capital into other parts of the business, and look, it makes sense when you're founding a business, you have very constrained resources and you have to allocate those resources accordingly.
Mhm.
But if you're not going to invest any capital or resourcing in your finance accounting function, you're not going to be able to make decisions fast enough. And
Mm.
then ultimately, that's going to lead to either missteps or consternation around making moves or allocation of funds incorrectly. So our job really is to try and build more structure and rigor around that function on an ongoing basis so
Mm.
that the executive team, the management team, any other stakeholder group can clearly understand both historical data as well as clear understanding of projections so
Mhm.
that they can go ahead and make fast decisions to grow their business.
What a great response. Thank you. And this would be very helpful to a very large number of people who will listen to our conversation. A lot of them are startup entrepreneurs.
Great.
Eric, my next question is, what are some key financial metrics that growth stage companies should focus on?
Excellent question. So a couple, I think in a growth stage company, it's really hard to talk about any financial metric without thinking about cash. And everything we do ties back to our understanding of how does that impact cash.
Mm,
So I think as we think about businesses, I put them in sort of two buckets. One would be businesses that are generating cash flow, and the other would be businesses that are burning cash.
mm,
And we work with businesses on both sides of that equation. Obviously, many of these businesses are trying to get to the point where they start generating cash flow, but for businesses that are burning cash. One of the most important financial metrics is the burn ratio. And that ratio takes into account how much recurring revenue your
mhm.
business is generating and compares it to how much cash you're burning.
Right.
And that comes up with an efficiency metric. If that metric is, let's call it two,
Mhm.
that means that you're burning $2 for every dollar of recurring revenue growth,
Right.
and you want to try and bring that number as close as you can to one or even zero, which means you're actually not burning cash anymore.
Mm,
But and that metric, it's hard to you can't manipulate it, which is great. You're either grow using that money to grow the business,
yeah.
and if that money is being burnt, that is captured in that metric, so you
Mhm.
can't hide it anywhere.
Right.
And that really helps orient founders and executives around how efficiently
Mm,
they're translating their money and their capital into growth and revenue. So I
mm,
think that's a really important metric.
mm,
For businesses that are generating cash, we start to think about sales efficiency metrics. So for a lot of the businesses we're working with, they're B2B businesses in some way, shape, or form. They're selling to other businesses. So if we think about sales efficiency metrics, the thing we like to think about is either the LTV to CAC ratio or CAC payback period. CAC payback period in particular helps you think about, on average, based on all of the dollars of sales that you're bringing in, and how many months do you recoup your total cost of your sales and marketing function.
mm, mm,
And if you think about that, that allows you to adjust and orient yourself and say, we want to make sure that the dollars we're pushing into our sales function is
mhm,
leading to growth and leading to revenue. You typically want that metric to be around 12 months or less, meaning that for your revenue, you're actually seeing your the revenue that's coming onto your business. You're paying that back within a year.
Amazing. And you're probably also functioning as a fractional CFO for a lot of these
Yes.
startup founders. What are some of the areas in your view that a fractional CFO should prioritize for a startup or a founder?
Yeah, good question. So yeah, we take a team approach. So for a lot of businesses that are on the smaller side, let's call it sub $30 million in revenue, we effectively are the finance team. We are filling the roles of director of finance or CFO, controller. Sometimes we're supporting them across tax initiatives. We have a tax team as well, but we're and FP&A. So we are filling multiple heads and multiple seats within the organization, particularly within the CFO function. I think of a CFO as like a quarterback, someone who is making sure that the information that's getting to them is good, and then that you can use that information to make good decisions. So some of the key responsibilities that I see a CFO having are one, making sure that the accounting close is happening on time in a repeated way every single month,
Yeah.
and that they're getting that information consistently.
Mm,
If they're not getting actuals to them on a consistent basis, that signals a problem within the accounting and controllership function, and that needs to be fixed. The other area that a CFO should be thinking about is budgeting and forecasting. So this is thinking about and contemplating how the company should be doing. And
Mm,
so what we like to do with our businesses is once we're onboarded, one of the first things that we're doing if they don't have this is either overhauling or building an operational model for them. This is a bottoms up model that they can use to run their business. It thinks about costs and expenses, OpEx, headcount and hiring, COGS. It also has a very detailed projection of revenue and the mechanics of the go-to-market motion so that we understand how the sales function works and how the business grows. So as you think through all these things, if you can put that together, that will allow you to create a forecast and ultimately a budget. A CFO, one of their jobs, it should be comparing actual results month on month, so the information that they're getting from the accounting
mhm.
team and group against forecast and against budget
Yeah.
and comparing that through budget to actual so that we can compare results and say, how did we perform in a prior month versus how we expected to perform? And based on those results, do we need to update the forecast accordingly for future months?
Mm,
Is there new information that that should inform our forecast?
mm.
So a CFO should really be taking that into account every month, always doing a BTA, a budget to actual, and then making sure that we're performing against results and getting better and better. In the beginning, you may not be very good at projecting your performance, but over time, as you get more information, you should become better and better at projecting your performance month over month. And that helps you become a better operator. That helps you project cash better. That really helps you think about strategic investments in people and hiring better. And it really allows you to run the business at a much more accurate and better clip.
Great response. Eric, we've spoken about, finance and financial planning, but you also work a lot on acquisition, mergers and acquisitions.
Yes.
And my next few questions are for M&A. How do you help a founder assess whether their company is ready for an acquisition?
That's a good question. So, let me explain kind of what we do within the M&A space. So we have a transaction services group. That group typically focuses and works with investors that are either private equity investors in the lower middle market or existing platforms owned by private equity investors. Our team is typically performing a lot of the financial and tax due diligence on those acquisitions. So, an example would be we might be working with a fund. They could have a platform. That platform is going to be doing an add-on acquisition. They have that target under LOI, and they give us a call and they say, "Hey, we have a target under LOI. We have a 90-day exclusivity period. One of the work streams that we have to do is perform financial due diligence because we want to make sure we're our purchase price on this business is going to be accurate. So our team effectively will come in, perform a quality of earnings, which is basically a standardization of their financials to GAAP, and then that allows us to make sure that the valuation on the business is accurate. It's that process is much more in depth than what I'm sort of outlining here, but it basically adjusts for any non-recurring items and standardizes the EBITDA of that business. And that work allows the investor to make sure that it also helps the company that's being purchased as well, but it gives a clear picture of your financials in a standardized way and allows each party to have a clear picture of what's going on and make an accurate purchase price and be able to consummate that transaction.
Mm,
On the so that is one of our main functions within in the M&A space. We also can help with post-close activities and integration. So once the acquisition is actually closed, how do we integrate that company into the acquirer's existing financial operations?
mm,
That process can be pretty laborious and time consuming as you may have different systems, different people. We're pretty heavily focused on the finance and operations piece and accounting, but that integration piece is a very important next step
absolutely.
post
Absolutely.
acquisition.
Yeah.
And then on the On the corporate side, so on sort of the advisory side, we're not necessarily advising them around, hey, we think you should make an acquisition or we think you should go out and get acquired. Although at some point, if we have a business that is potentially running out of capital, they may get to a point where they either have to go out and raise money or pursue an acquisition. And
Mm.
at that point, we are going to advise them that, hey, we have 6 months left in runway. We're gonna need a capital event here. And at that point, we're telegraphing that far in advance. And at that point, the founder should be very aware that they either have to pursue an acquisition or a new capital partner
Mm.
because they're not going to be able to exist anymore.
Very interesting. And when you're looking at an acquisition from the perspective of a buyer, what are some of the financial red flags that you normally look for and advise the buyer?
Great question. I think there's like so when I think of a so I think there's a couple different things. When I think of a red flag, I think of like something that would prohibit an acquisition from occurring. And then I think of there's other metrics that would help either improve or detract from the purchase price, but may not be like a red flag. But if you're specifically thinking about red flags, we think of a couple of things. One would be like that there's not bank reconciliation done on the books so that we can't trace the cash that is supposedly coming in the business and making sure that it's coming into revenue or getting pushed on the balance sheet. Another area that we think about would be the collections. So if a company has poor collections or has write-offs that are above average for their industry or sector, that would be a potential red flag. Other areas would be like DSO, so days sales outstanding. So maybe they have potential issues with payables and paying vendors, or they have issues where they're not able to make or they're not consistently making payroll. All of these areas are potential red flags. We've also seen things where businesses have multiple entities.
Mhm.
So maybe they have a few different entities, and we're seeing a lot of intercompany transfers between the entities to try to avoid taxes.
Mm.
And in this is something that we uncover in diligence, but could be a red flag, which shows the owners are being either deceptive or they're not being truthful about the amount of money that's coming to their business in an attempt to avoid taxes. These are all things that we've seen during diligence. Another thing, which is maybe not a red flag, but things that we see would be owner operated businesses where they're pushing high amounts of personal expenses through their business and trying to basically communicate those as business expenses when in fact they're personal expenses. I think there's a materiality there. There's
Yeah.
always some personal things that get pushed through, but we've seen egregious amounts where it's hard to justify, and buyers should be potentially aware of those instances.
And what, in your view, are some of the common reasons a lot of deals fall apart uh, during the due diligence process?
Oh man, I mean, it doesn't even have to be financial. There's financial is just one work stream. Deals can
Mm.
fall apart for a variety of reasons.
Mm.
Something on the financial side is just one thing. It could be tech related. When the tech diligence is done, there could be some materiality issues with coding,
Mm.
or scalability of coding that they uncover. There could be tax implications where maybe there was a lien on the business or the business owes a material amount of sales tax in
Mm.
states where they've been operating and haven't paid. There's could
Mm.
be a few $100,000 of sales. We've seen that before. There could be
Mm.
sales tax liability or any sort of tax liability. So we do a lot of tax diligence as well to uncover any potential liabilities on the tax side with income tax, real estate tax, sales tax. There could also just be mismatches with ownership and price. Sometimes what can happen is they find or uncover something that's material, and the investor wants to retrade, meaning they want to try and change the original purchase price. That could then impact the outcome for the seller, and ultimately that doesn't allow the deal to go through because the seller becomes unhappy, and then the deal kind of starts to fall apart. But when you see, and then the last thing I'll say is there could be an issue with commercial diligence, especially in some of these smaller deals. Commercial diligence relates to some of the areas around market sizing, TAM, understanding kind of what is the opportunity. And once you get under LOI and you start to understand what the ideal customer profile looks like, there's potentially areas where commercial diligence uncovers maybe this isn't as big of an opportunity as we thought. And in which case, the investor, which is obviously investing in future periods of operations of the business, thinks to themselves, actually, I don't know if we're going to be able to grow this thing or capture as much market share as we thought, or the market is smaller than we thought. And actually, I think maybe we part ways and don't do this deal. So there's a variety of reasons that deals can fall
Absolutely.
apart. But the hope is that once you get under LOI,
Mm,
we see the majority of deals go through because usually the investors know the space. They've
mm.
been talking with the company for a while. They know their business. They've done initial diligence. They've done initial conversations with the management team. So they're not going into this conversation blind. So they typically deals go through once they're under LOI, but we've of course seen things break up at the last minute.
Very interesting. I have time for two more questions for you, Eric.
Sure.
How is technology and blockchain and AI, of course, have been are now being used extensively in the finance and accounting world. I'd love to get your perspective on how is AI and automation going to change the financial and financial advisory services?
Yeah, it's a good question, and it's obviously a hot topic. I guess I'm maybe more on the side of AI skepticism. But I do think it will have a material impact. I just from what I've seen so far, haven't been incredibly impressed with the products out there, but we do use some tools even within our ongoing workflows today, that help with building automated schedules, that help with data organization and cleansing, and help with some of the pattern recognition, especially with some of the more recurring tasks. I think that the reality is that something that can be processized, AI can start to learn that over time, and you're seeing that some of those tasks become automated, and where humans really start to then become and support is the analysis of that information, but the actual um, hands on keyboard work to crunch that data, that becomes more in the AI, or data automation realm.
Mm.
And we're already starting to see that a bit. But I do think like the idea that like AI is going to come and take everyone's job within the
Yeah,
accounting and finance world. I,
that it won't. Yeah,
I do feel is a little bit overcooked. I think you
correct.
still need people to analyze, to be able to have thoughts around and contextual evidence around how these things all play together. And I just don't see that changing within the next few years.
Absolutely. I agree. I agree with you completely. AI is going to be an enabler rather than taking jobs.
I think so. I mean, I think broadly, broadly that it will have a bigger impact. I think
Mhm.
within the accounting and finance world, it probably helps people do their jobs better over time. But I am very interested to see how it evolves because it's a very hot topic. It's brought up almost every day, and it's something we're thinking about pretty actively.
Absolutely. And my last question for you, Eric, and this is for you and the Exbo Group. Um, where do you see the Exbo Group in the next few years? And how do you plan to expand further?
It's a great question. So I've been operating the company and for about 8 years.
Mhm.
We've grown from two people, just me and Kevin, to 65 professionals. So we've been able to scale the business pretty significantly over that time, and I think um, so. How have we grown that? I think really it's driven by high levels of service and excellence. We really tried to have a very high quality team and very high quality work product. That is within professional services, that is what leads to growth and more business. So I think at a very base level, we'll continue providing our clients with a high level of service, be very hands-on and white glove, and have a high level of kind of like attention and to detail around some of our clients' issues. At a strategic level, I think that means that we are going to continue to think about both expanding the businesses we're already in. So finance, office of the CFO, accounting, tax, advisory, transaction advisory. But then also thinking about, are there any other areas that we want to expand to? So that could be finance transformation, where we're starting to do work, but we have more opportunities. So
Mm,
these are like helping companies really in the first 90 to 180 days transform their finance and reporting function and expanding that and moving up market. We've already started doing some work within NetSuite implementation,
mhm,
expanding that. There's a huge opportunity there as our clients have grown. As we've grown, our clients have grown and moved up market with us. And there's opportunity to help them move on to more substantial ERP systems. And then there's opportunity also to just expand services horizontally within the space, whether that's valuation services, investment banking, moving into other areas of diligence, where we won't go too far out of our core areas of competency. But what we've always been able to do was listen to clients. And if we're continually being asked to do something that we don't do,
mhm.
we should think about, is this a service we could bring on or build internally? Because it seems like there's a good opportunity there. And that's what we've done historically, and I think we'll continue to do that. So we have a couple of ideas around what areas we can expand in the next few years, and a few of which we'll probably pursue, because we think we can grow those.
Good luck for that. But on that note, Eric, I just want to say thank you so much for talking to me. This has been an absolutely fascinating conversation for a lot of young startup founders. This would be such an amazing 101 for in terms of knowledge for finance, financial planning, financial strategy, and of course for mergers and acquisitions. Thank you for speaking to me and good luck to you.
Thank you so much, Asutosh. I enjoyed being here. Appreciate the time.
Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the brand called You.